All right. I believe we are live here with Rob Beardsley. How we doing today, Rob?
I'm doing great. Glad to be here.
Thank you, my friend. Glad to be here as well. So, of course, my name is Aaron Fragnito. We are live on Facebook, LinkedIn, and YouTube. So hopefully you've had a chance to catch us here and enjoy what we're going to be talking about today. And Rob Beardsley, I'll have you introduce yourself, Rob. But of course, my name is Aaron Fragnito. I'm owner of People's Capital Group. And we focus on helping people invest in apartment buildings here in New Jersey. But Rob has a different strategy. And so we'll talk about our different strategies today a little bit, how we also team up with other people to raise capital and how we help people invest in real estate. So Rob, what do you focus on there at Lone Star Capital?
So we are a New York-based investment firm, but we focus exclusively on Texas workforce housing. So we've got our own property management company in Houston that oversees our portfolio on the management and construction side.
Awesome. Houston, how'd you land on Houston and being your main spot to invest?
Originally, when my business partner and I connected, we were working with a mentor who owned a lot of property in Texas as a whole. And so we figured that we might as well start in Texas as well. And as we were canvassing the major markets in Texas, we got the most traction in Houston, and that's where we bought our first deal. And then from there, it was just kind of off to the races, and we started building momentum and relationships in that market. And that's just kind of what has led to our continued success. Rather than trying to go and reinvent the wheel in a bunch of different markets, we've just stayed focused so that way we could become local experts and get better deal flow.
Okay, awesome. And you've had a lot of success there, right? In the last few years, you've been able to acquire how much real estate in that state?
350 million about in the last 4 years or so.
Excellent. Yeah, that's why I want to have you on, because you work with a lot of other people to raise capital, and that's called a co-GPing. Sometimes there's many different terms for it, but essentially co-fundraising and teaming up with other professionals to raise capital. But there are rules and regulations in the space, and sometimes they can be tough to navigate. So I did want to break into it a little bit today. We'll speak for about 20 to 30 minutes or so about this topic and just general tips on investing in real estate as well. And yeah, let's break right into it. So I know that you do raise some capital in-house. You also team up with other GPs. Is that where most of your capital comes from other GPs, or you also raise most of your capital in-house, or what's usually your structure there?
I would say only about 20% of our equity comes from our network of private retail investors, just your typical private equity investors. The rest of it comes from co-GP partners, fund of funds, private equity firms, family offices that are contributing larger checks, anywhere from 500,000 to 15 million.
Mm-hmm. Okay, excellent. And then, so as far as teaming up with other people, right? And that's really the topic here today. How do you usually structure something like that when you're going out and you're raising new capital for a deal? How does that usually structure on your end?
Well, there's a few different ways to go about it. And so the typical co-GP route is where, you find someone who you want to work with and you actually bring them on to the GP or the general partnership, basically as a owner with you in the manager LLC of the venture. And through that, you're able to then share in the responsibilities, share in the fees, share in the upside, share in the depreciation. You can really divvy it up how you like. And like you mentioned, you hinted at kind of some of the SEC requirements, and that requires your partners to be active participants in whether it be marketing, due diligence, asset management. So we do a few things on the back end, legally as well as just structurally, to make sure that we're doing things appropriately on that front. So that kind of is the co-GP side of things. Mm-hmm. And then from like a joint venture side of things with a family office, for example, those typically look more like a 90-10 partnership. And so you'll hear that 90-10 split a lot, where the capital partner is putting up 90% of the equity And then the sponsor, which is us, is putting up 10% of the equity. And that 10% doesn't necessarily have to come 100% from your pocket. It could also come from your private investors. It just depends on the agreement
Mm-hmm.
and the structure. So in those deals, when you have a 90-10 JV, then you're not necessarily have a co-GP partner. It's just an LP partner, but because they're a major LP partner, they get better terms than the average LP in a syndication, if that makes sense.
Sure. Absolutely. And then, so do you have kind of restrictions? How do you decide who to team up with when you're co-GPing with individuals?
Well, what we're really looking for are long-term relationships, repeat relationships. Nobody wants to put an effort to build trust, get to know somebody, and then just do one deal, right? That goes for both sides. So we're the same way. We're looking for partners that we can work consistently with, that we can rely on, because it's a two-way trust game, because we're trusting them to bring the capital in order for us to close, and then they're trusting us that we have a deal for them and that we're not just going to run off and maybe fill it up with other investors because they came in sooner or something like that. So there's trust that we're going to carve out space for them in the deal. So those are the big things: trust and then consistency. That's what we're looking for in partners.
Mm-hmm. That's excellent. The same on our end. At the end of the day, you can only do business with people you trust, who are loyal to you, and also show that trust and integrity right back. And something like raising capital, structuring a deal, there's a lot of variables. There's a lot of moving pieces, and people have to have integrity. They have to do what they say they're going to do. If they don't, things can go south. So I find that, whether we're hiring a contractor or working with a tenant or raising millions of dollars, it all comes down to the same type of structure and same type of strategy where, the person has to have your best interest in heart and the team's best interest in heart, so that we're really working towards the same goal. And there's also a cost to that as well. So I know sometimes you share assets under management fees, or I know that's actually something that is kind of a topic we touched on a little bit at your event the other month. But I guess is it fair, or you don't have to disclose this, but as far as sharing the asset management fee, if someone's bringing in 20% of the capital, do they get 20% of that ongoing fee? Or you could also argue that the operator is really entitled to that because they're doing all the heavy lifting behind the scenes continuously, and the person who helped you raise the capital is kind of not really participating as much at that point. So you could also argue it's not fair for them to get the AUM. And I've heard both sides of the argument. What are your thoughts on that?
I think that you made good points on both sides. And at the end of the day, both sides need to look at the compensation in total. So we might say, well, hey, sharing in our asset management fee is unfair because we're doing most of the work on the asset management side of things. But we would need to look at the total partnership compensation and say, well, how much of the acquisition fee are they getting? How much of the promote are they getting? Because if they're taking a very small piece of the acquisition fee, then maybe it's more appropriate for us to then share in the asset management fee. So I think you just need to look at the totality of it. And at the end of the day, right, that's what everyone cares about is money. So a partner isn't really going to care whether they're getting an asset management fee or not, as long as they're getting money in one way or another, right? They don't care what the fee is called. So for simplicity reasons, we prefer not to share in the asset management fee, just because that's another monthly distribution to deal with. I mean, certainly we can handle it. And we do have partners and deals in which we do share in the asset management fee, but we just look at the partnership in totality and say, well, is this fair? Does this make sense? Because looking at each item individually, you don't really get the full picture.
Absolutely. It's about the bottom line for each person, and also how much they're bringing to the table. If someone's raising 75% of your capital, well, maybe that entitles a larger fee. And then as far as the acquisition fee goes, which for our listeners that don't know, by the way, an assets under management, AUM, is generally a fee charged. It can be done a couple different ways. The more common way you see now is a percentage of rent collected, which is, I think, a pretty fair way to charge an AUM, because if you're not collecting rent, then you're not really entitled to your ongoing fee there. But I've also seen it as a percentage of funds raised, so that it can be done that way as well. But it's generally an ongoing fee that's paid to the operator year over year, or on a monthly basis or something like that. So an acquisition fee is a fee that's charged upon the acquisition of real estate, which is a pretty cool part of our job here. We get paid to buy real estate, which is actually a very nice part of the structure, but there's a lot of work behind the scenes that goes into that. And there's a reason we need to charge an acquisition fee, because there are hard costs to raising capital, structuring a deal, and making sure that the deal is the right opportunity, finding a deal. So there are hard costs to that, and the acquisition fee tends to kind of reimburse the operators of all those costs and keep our lights on. Now, sharing that acquisition fee is one thing you can do as a operator with your other people that are helping you raise, your other general partners. You can also not share the acquisition fee and share the AUM. You can do a larger piece of equity on the promote side. That's what Rob suggested there. So a couple different ways to cut up the pie there. And of course, everyone just cares about, well, how much am I getting at the end of the day, whether I get it this way or that way, in the back and the front end, right? How am I going to get compensated fairly for my time? So the acquisition fee, that's interesting. So sometimes you do give a percentage of that as well to co-GPs. Is that right?
Yeah, I mean, everyone likes to get paid at closing, right? Closing is an exciting time, so I think it's a good time to share the success and the wealth. Mm-hmm. But going back to your point about acquisition fees and kind of explaining the rationale behind them, it is a very interesting topic, because some people don't like the idea of sponsors taking a big acquisition fee at closing, because they think that they're getting overpaid, or the alignment of interest isn't there, right? Because the sponsor's just getting paid to close the deal. Who knows if the deal's any good yet, right? And so to mitigate that, some investors will want to see the sponsor to actually co-invest. I mean, every investor wants to see their sponsor co-invest into the deal, which means the sponsor's investing alongside the investors, which makes them feel more comfortable and confident that the sponsor is eating their own cooking, right? Mm-hmm. Sometimes you see people wanting to see the sponsor invest in excess of the acquisition fee. They say, well, you're telling me you're investing $200,000 in the deal, but your acquisition fee is $500,000. So you're actually investing a net of negative $300,000, right? You're still walking out of the deal with no investment, technically speaking. And those discussions I have a lot with savvy investors, but I take issue with it because, first of all, that acquisition fee doesn't come to me, right? It goes to my company. And then, so before it even gets close to my partner and I as a profit distribution, it flows through our company, pays for all of our employees and our operating costs. We just moved into a new big expensive office. So now that's going to go, the acquisition fee is going to help pay for that. And you really don't, so out of a big acquisition fee, at the end of the day, I'm walking with usually very little, at most something like 50,000, because I do aggressively reinvest back into the deals, as I should. I want to be investing with my investors, and I want to be investing in multifamily. So the point I wanted to make about that was, you don't really start to break even on your operations until you have about $500 million to $1 billion in assets under management. At that size, you no longer have to live off acquisition fees. But up until then, every sponsor that you see out in the world is relying on acquisition fees to live and pay their business expenses. So to ask sponsors, hey, what's your acquisition fee for, or can you reinvest it all into the deal? It's just very, very unrealistic for most of us. So yeah, I think that's an interesting conversation that you don't really hear people talk a lot about in the space.
Yeah, absolutely. And it's an interesting structure. So we work fully with retail investors. We really aren't on the institutional side. We're people's capital group, so we help people invest in real estate. And we're not opposed to. We are in conversations with some hedge funds and family offices, and we're not opposed to. We would probably structure actually a new fund for those types of institutionalized investors. Because retail investors, which, by the way, for our listeners, if you haven't read Rob's book, Rob, what's the title of your book there?
You got the new one?
The new one, yeah.
Structuring and Raising Debt and Equity for Real Estate.
Awesome. Which, by the way, I assigned to my class at Rowan University. They asked me to teach a course there and write a course called Real Estate Entrepreneurship. And I agreed for one semester, just so I wanted to, have that experience. And so it's really interesting. I signed your book for a number of reasons. I read it. It's an easy read. It's only about 100 pages. So, you're not, it doesn't, it kind of moves quickly. But it's also very in depth. So if you're if you're curious with the feedback of 32 college age students, the feedback on your book is it's very in depth. It's kind of complicated, and they were having trouble understanding some of the terms because they were so in depth. And I read it, and I've been doing this about 12 years or so, and I loved it because I was like, oh, this is so in depth. It's so spot on. But it's not like a bunch of fluff either. Kind of right to the point. Right. So. And then I made a quiz for it, and it was like a hard quiz because it was based on the book, and the class didn't do that good. I had to actually curve the quiz so that the average grade wasn't like a C-. So hard book, hard quiz, hard professor, but so anyway, hopefully you got a few sales there as well. But
yeah, sounds like fun.
Yeah, definitely. So they were supposed to buy your book. They better have. So anyway, that book was great. And the reason I'm bringing it up is because in it, you talk about the co-GP, you talk about the fees and how to kind of divvy them up as well, the debt side of real estate also. Boy, I forgot my question though, but what I found really interesting about it was that there is no set way to do this. The answer to a lot of your explanations was, it depends on the deal. It depends on the people. It depends on the investors. And institutionalized investors are going to require you generally to put down about 10% or so. It depends, maybe 5%. Depends on the size of the deal, how many deals they've done with you, and so on, of the amount you're investing. Now, when we buy a property, we do sometimes come in with capital, but it's viewed just as LP capital is viewed. But generally, we have so many investors that we are able to raise, 100% of the capital required for the deal. And with retail investors, these are smaller private investors. These are people that, hardworking business executives. I mean, we run a 506B, so I have non-accredited investors, teachers, firefighters, people in the industry, realtors, people out of the industry, bankers, people like that. So, and really, that when you're running a retail fund, as we do here at People's Capital Group, you can structure it in a little bit different ways. So sometimes we do come in with cash of our own on the LP side if we're very liquid at the time. Other times, if we have investors to serve, as you got to put their money to work quickly, or they're going to go online and Google real estate syndication near me, or they're going to see Lone Star pop up. They're going to say, I'm going with Lone Star. There you go. So you lost it, right? So you got to, move that money, have a place for your investors to put it quickly, especially on the retail side. When you talk to a hedge fund or a family office, that's a relationship building process. They understand, hey, maybe this deal, I didn't get it, but give me 6 months, give me a year. I'm glad we have this conversation. Let's keep having this conversation. Let's line up another deal. They understand that they're patient generally, although there are times where they go back and they're like, sorry, money's not there. But it's more common with retail investors because they don't have as much liquidity. So in that case, you do need to kind of put that capital to work quickly. And that's why we always try to have an opportunity for our retail investors. But on the institutional side there, so you have to watch out. Yeah, you really need to come up with a large amount of capital. I mean, 10% of the funds you're raising could be $1 million, right?
Yeah, exactly. And so that is unrealistic in most cases. The ability for a sponsor to truly put $1 million into a deal out of their own pocket is not likely. And that's even if they have that $1 million, it would be unlikely and irresponsible for them to do that because they have other deals that they're likely trying to do. And so you can't just run around putting down $1 million into a bunch of deals because most sponsors don't have that, even big ones don't have that. And secondly, it's also the investors that are requiring this have to ask the question: would we rather have our sponsor put $1 million into this deal and really put themselves in a liquidity crunch, or would we rather have them put that $1 million into their business and let them hire more people, let them grow and build out their infrastructure and have cash on the sidelines as well, liquidity, so that if anything does happen at the property level that's an issue, the sponsor's first line of defense is their own money, hopefully, rather than a capital call to investors. So in a perfect world, yes, you're investing with a sponsor that's 100 millionaire and can put $1 million into every deal and all that stuff. But that's just it's not very realistic. So a lot of investors know that, and they're okay with the sponsor putting up that $1 million from other sources, right? So you might be able to go to your People's Capital Group investors and say, hey, I need $1 million. Let's get 10 people to put $100,000 in, and maybe you're one of those 10. And now you've put up your $1 million. The institutional investors put up their $9 million, and now you've got yourself your $10 million check.
Mm-hmm. Great. I love it. Yeah, that's a great way to go. And I was actually talking to Arbor Capital there and kind of trying to structure that in a couple different ways. That was one of the companies I met at your event there at Lone Star Capital. That's great. All right, Rob, I just want to shift here quickly, and we'll wrap up here for the afternoon by 2 o'clock or so onto just kind of building, networking, branding. You're excellent at it. I went to an event you held in New York City about 3 weeks ago. Thank you for that. And was it, I guess now it's about a month ago or so, and met some real people, there's some real players, some good, service providers, the whole spectrum. I was impressed with what you had to say on stage there and the people you were bringing up on stage as well. So, and then you were down in Texas, like not a week later, at another event speaking. So, how do you manage, all these places you have to be at once while you're still acquiring apartment buildings, right?
Yeah, well, it's all about a team. And so the way I look at things is I need to build a system for everything. So before I can build a system, I need to do it myself. And when we first started our marketing strategy, I was doing everything myself, and I was posting on social media and doing everything, right? And I wasn't on every social media at first, right? So when you're talking about social media, I recommend just picking one medium or one style of content, one social media, and sticking to that. That might be a podcast, that might be YouTube videos, that might be just writing posts on LinkedIn, right? So stick with that for 6 months, groove that. Then you can start layering in more social media. And then at this point now, we have a marketing team that I just, will make an article or make a video, and then that gets edited, that gets repurposed, that gets reposted all across multiple social media. And I really don't spend very much time on that at all. So at first I spent a lot of time on it, then I built the team and the system, and now I don't, and that frees me up to move on. And like you said, going to events, I try to be selective with my time because I can't be at every event, but I do want to speak at events and make the most of my travel schedule. So the thing about events is you don't know until you go. You're always taking a risk. Like you took a risk with my event, so I really appreciate your coming to the event and getting something out of it. But the reality is you go to other events and you kind of walk away going, maybe I feel a little motivated, but I don't really feel like I got my money's worth. More importantly, my time's worth.
Yeah.
So that's something that I continue to be more selective about and make sure that I'm getting an ROI and being intentional with what I'm doing. So, I mean, like you said, it'd be nice if I could be 2 places at once, but I actually can't. But to finish the thought about the team, because you're saying, hey, you're doing all this and you're buying deals at the same time. We have our acquisitions team that is very strong. And I, again, originally underwrote all the deals myself, talked to all the brokers, made every little decision on the acquisition side. And now I've built a team over 3 years to where I can trust them with a lot of the acquisitions process, to where I'm only needed to be involved in the kind of the final stages and in high level matters.
Mm-hmm. Mm-hmm. Very nice. Yep. Same structure on my end. I have a social media team. I have an SEO marketing, website team. Of course, a video. I have like 4 virtual assistants. My property managers have virtual assistants. My operations manager, business partner, Seth Martinez as well. We're a big fan of VAs, but you can only get so far with a VA as well. You kind of do have to eventually have someone, in the office, boots in the ground. And another point, I've really enjoyed working with your company to set up this event here. And Dasha, your sister, has been very enjoyable to work with and very professional. I enjoyed being here at the event as well. So you're kind of a family-run company a little bit at the end of the day. Is that right?
Yeah, I mean, all of our hires have been very relationship based.
Mhm.
So when my sister graduated, I mean, it wasn't a plan, it wasn't a master plan that all
Mhm.
along that she would come and work with us, but it just kind of naturally happened as she was graduating, and she interned for us the summer before, so it just was a natural fit, and it's working out really well. And our other hires have come through friends and family. Yeah, everyone that works for us here in the corporate on the corporate side in New York is all kind of extended friends and family. So I that's a really good way to go, because there's that built-in trust and connection. So I think, I mean, but aside from that, we've gotten extremely lucky with our team. Hiring is not easy,
Mhm.
so that's been really good for us.
Yeah, I feel it's a kind of a young company in a sense. A lot of your employees seem to be under the age of 40 or so, or and I like that vibe. I think other people like that too. It's kind of new and fresh, which is not really what you see in the institutionalized world of commercial real estate. It seems to be kind of an old boys club in a way. So it's a bit of fresh air there. Now, before this, was your family in real estate at all, or you were kind of taking the first plunge here?
Yeah, my parents were in residential real estate, so they were brokers. So they were buying and selling homes for their clients, and they did some fix and flips and development all on the single family side. So they never, for some reason, never got into multifamily. But 6 years ago, I I myself got into multifamily, and I kind of really urged my parents to start investing into multifamily and looking at the asset class. And um, my original plan was to start a new company with my dad, but he was too busy. So I went off on my own, met my business partner, and started Lone Star and all that. So it's all worked out. But yeah, no, definitely have real estate in my family and in
Yeah.
my growing up.
Cool. It's in your blood. Awesome. And your business partner, you're more the face of the company, it appears, at least from what I can see, and your partner's more kind of on is on the operation side. That's the structure I have. My business partner, Seth Martinez, he's right over there in the other office, but I'm more the guy out here doing these events and the marketing and branding, investor relations. Is that the structure you have with your partner as well?
Yes, absolutely. So he much prefers to stay out of the limelight and just focus on business. So he runs our operations, our asset management team, our property management team, construction. So he's got his hands in everything, which I don't like very much because I want to see him delegate more and really focus on higher level stuff. But he loves to be involved everywhere, which, I mean, he does a great job of it. But I think for growth reasons moving forward, we need to continue to focus on how we can build the team out and really focus on the most productive activities.
Yeah, and that's one of the hardest things we do as entrepreneurs is handing the reins off to your employees, right? Because it's our baby. I mean, me and you, we wake up every morning, we focus on our businesses, we go to bed at night. We're thinking you got to get it out of your mind and you go to sleep, and but it is
Yeah.
becomes part of who you are. And when business is down, I'm down. When business is good, I'm on top of the world, man. I mean, I love coming out of a meeting, raising a big number. It's just a phenomenal feeling. Building that relationship with a high net worth individual, helping them invest their capital, or heck, just helping someone invest $30,000 from their IRA. That feels great as well. But yeah, you're absolutely right. Delegation is so important. I think every operations manager struggles with delegation, any entrepreneur really, because you're building that system. And we've also, at least me, I've hired the wrong people too, and I've fired people, so that's not a fun experience. And sometimes you're cleaning up after them and whatnot. And I always say I'm more careful with my own capital, with my investors' capital than I'm with my own. If I'm going to invest someone else's capital, man, I really want to make sure everything goes perfectly, everything goes according to plan. And although, life happens, you can't control everything. I want to make sure I do whatever I can do in my nature to make this deal work and hit those targets or better. With my own capital, I'm like, oh, I'll do this, I'll do that. Oh, cryptocurrency sounds good. Here's 30, but and I paid for it. So at the end of the day, I'm always more cautious with other people's capital. I feel like most of us syndicators are that way, right?
Yeah, I agree. Absolutely.
Mm-hmm.
Because you're only answering to yourself with your money, and answering to someone else is very different. And that's why a lot of people come to me for advice and say, well, do you think I should get experience with my own money first, and then once I've done a deal or two, whatever, with my own money, then raise capital? And I don't recommend that, because the sooner you get to raising outside capital, the sooner you will take everything more seriously and just be held to a higher standard, because that's just the way it is. So
Yeah,
I think that's absolutely the way to go.
I think you're absolutely right. The catch-22 is, it's hard to raise capital when you haven't done a deal. So, but hey, that's the art of fundraising, building those relationships, having your people in place, having your structures in place. If you have a good package and investment package for those private investors, there are people that will invest in first-time syndicators. I personally probably wouldn't, but it's definitely a space I see. And if you're coming off another business success, I had a successful company in this space or that space, I know how to run a business, I know how to hire, fire, make decisions, then that always helps. But I was fresh out of college getting into real estate, so I had to kind of learn the business a little bit. I was a realtor, a wholesaler, fix and flips, and so on. And did you get right into the syndication space out of college as well?
Yes.
Interesting. Okay. Excellent. All right, Robert. Well, it's great chatting with you here. I know you got to run. I do as well. So how can people get in touch with you to learn more?
To learn more about what we've got going on at Lone Star Capital, you can head over to our website, lscre.com. That stands for Lone Star Capital Real Estate. So that's lscre.com. Also, we touched on the book. Really excited about the new book, and it's just structuringandraising.com. So very simple, structuringandraising.com for the new book. And if you want to reach out to me directly, connect with me and message me on LinkedIn. I post every day on LinkedIn. I'm very active over there. So I look forward to seeing you there.
Awesome. Thank you, Robert. And of course, if you want to connect with People's Capital Group, you can go to peoplescapitalgroup.com. We focus on New Jersey apartment buildings and helping people invest in good buildings here in New Jersey. We're actually buying one in Bayonne right now. So Robert's focused on the Texas market. We're focused on the Jersey market. There's no right or wrong answer in real estate. The bottom line is you got to be putting your capital to work. So if you're not diversified into real estate, check out Lone Star Capital, check out People's Capital Group. Do your due diligence and find the best fit for your investment goals, and put your capital to work in brick and mortar real estate with experienced professionals. That's the most important thing. But thank you so much, Robert, for joining me. Buy his book, by the way. I really enjoyed it. Hopefully all of my college students bought it, but I feel like they didn't all buy it because they didn't do too good on that quiz. So they just told me they bought it. All right. But you have a good day, my friend. Thanks a lot.
Thanks for having me. I'll see you later.
Thanks.